Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is the monthly talk on monetary trends. But this time, as in January, I want to talk about a wider topic. The current monetary trends are covered in our attachment to the monthly email, which you should receive. And they are indeed very interesting, but I want for the moment to pick up what I was talking about in January. There I was talking about the forces that determine the level and the rates of change of what I call variable income assets, which are mostly equities and property. It is in real estate. And I argued there that the dominant driver in the movements of these asset prices for these two categories of assets in the long run is the quantity of money. Now this time I want to focus on fixed interest assets or bonds, and in many of these treatments that I'll be talking about, the yield on bonds is taken to be the rate of interest. That's for discussion, because actually the rate of interest is also what banks charge us for their loans, and it's also what the central banks charge the banks for their loans from the central bank. And it's really central banks that set the short-term interest rate. Anyhow, there is a large body of economic theory on this topic, and far more, in fact, on the topic of what are the determinants of the prices of equities and real estate. Now we have to go back to, I'm going to do a kind of overview of the history of thought on this subject. I have to go back to the late 19th century for the first serious thinking about it. There's a chap called Wicksell, who's a Swedish economist, who proposed something called the natural rate of interest. I haven't got time for that here. And also an Austrian economist, a chap called von Bohm-Bawerk, who talks about the roles of impatience. We have to defer consumption to save. We need a rate of interest as a payment for impatience. And also roundabouts, the more capital equipment is required, the longer it takes, the higher the rate of interest required. And these kind of things were how Bohm-Bawerk theorized about the rate of interest. Anyway, I don't want to talk too much about those two guys, important though they are. I want to start with a chap called Irving Fisher, often regarded as America's greatest economist, who in 1907 wrote a book on the rate of interest. He made references to Bohm-Bawerk and so on, but the key idea he's really associated with is that the nominal rate of interest has two bits. It has a real rate of interest, a real rate of return, and the rate of expected inflation. Plainly, if inflation is reducing the value of money, then we as savers require a higher nominal interest rate to compensate us for that inflation risk, for that expected inflation. And Fisher was also one of the pioneers of the quantity theory of money, and in 1911 he published another great work called The Purchasing Power of Money, in which he put forward the proposition that in the long run, movements in prices depend on movements in the quantity of money compared with movements in the quantity of goods and services. Now let's put these two ideas together. Plainly, if, thinking in Fisher's terms, there's more money, faster rate of monetary growth, there's going to be more inflation, and logically people will expect that inflation, so there is going to be a link of this kind between money and the rate of interest. The more money there is around, I know it's a very vague phrase, I know it is, the more money there is around, the higher the rate of interest in nominal terms. Okay, that's a perfectly reasonable theory. Let's now move forward about 25 years. Let's move forward to Keynes and the late 1920s, 1930s. Keynes wrote a book in 1930, The Treatise on Money, which referred a bit to Wicksell. But in the General Theory of 1936, much more famous book, Wicksell was forgotten. And instead, Keynes proposed his own theory of the rate of interest, so-called liquidity preference theory of the rate of interest. This appears in hundreds and hundreds of textbooks and is a standard instruction in a university course in macroeconomics. Let's think about an investor, I think a very cautious investor running funds for, say, an Oxbridge College. And you're going to hold money and bonds, both very safe assets. And plainly, the higher the rate of interest is on those bonds, if the bursar holds only money, then he's losing that high rate of return. So the higher the rate of interest, the less money is going to hold. When interest rates are down, the bursar is going to have all the returns of the benefits of the flexibility that cash gives, and won't have much lost by way of investment returns. And there may be a very low rate of interest when the investor really doesn't care at all about how much money he has relative to bonds, because actually the risk that the next move in interest rate is upwards, giving a capital loss on the bonds, causes him to just let money balances rise without limit as if more and more money comes into his hands. So we can express these preferences in a curve. In a curve of this sort, again, it appears in hundreds of textbooks. Sloping downwards to the right, and it's called the liquidity preference function or the demand for money curve, whatever. Then if we add up all of these individual money demand functions or liquidity preference curves, and we help one for the whole economy, and we say that the central bank and the government together can control the quantity of money, it becomes a straight line, and then we say that the state, central bank, can increase the quantity of money. That means that the quantity of money goes a bit to the right in this curve, and the rate of interest goes down. It sounds very plausible and so on. But what we have here is, again, I'm going to simplify a bit, the more money there is around, the lower the nominal rate of interest. So we have a conflict between these two great authorities, Irving Fisher and John Maynard Keynes. One says the more money there is around, the higher the nominal rate of interest, and John Maynard Keynes says that the higher the quantity of money, the lower the rate of nominal interest. Which is right. Now, you might go and think, well, Milton Friedman, who was at university in the early 1930s and was influenced by both these great figures, might give us some wisdom in clarifying what's going on here. And I'm going to now quote Milton Friedman on this subject. I'm quoting from an entry in an encyclopedia, the so-called New Palgrave, dictionary, not encyclopedia, a dictionary of money and finance, this is from Friedman's entry on the quantity theory of money. A change in monetary growth affects interest rates in one direction at first, but in the opposite direction later on. Money growth at first tends to lower interest rates. Why did Friedman say that? He was plainly referring to Keynes's theory. Seems to me there's not much doubt about that. He then says, but later on, the resulting acceleration in spending and in inflation produces a rise in the demand for loans, which tends to raise interest rates. In addition, higher inflation widens the difference between real and nominal interest rates, this thing that Fisher had talked about in his 1907 rate of interest. So this bit, sort of later on, is all about a reference to Irving Fisher. What is the answer? Friedman was all in favor of having testable hypotheses that you can go to the data and work out what the correct theory is. I put it to you that these remarks are so casual and so unclear that we simply couldn't test them against data. They are the worst kind of casual empiricism. Friedman did not have a theory of the rate of interest. And what he was trying to do here was to put forward a compromise between Fisher and Keynes, which I'm afraid doesn't really work. There is another approach to all this, which sort of goes back to a chap called Sir John Hicks, who wrote another great work in 1939 called Value and Capital. And what's going on here is that there is the very very short-term rate of interest, take it to central bank rate, and then investors have expectations about what that rate will be in the future, and then the longer-term rates are going to reflect the short rate and those expectations. All right? That's in chapter 11 of Value and Capital. Now, I suspect that most economists would be, when pushed, more comfortable with this than with the monetary theories of Fisher and Keynes and Friedman. And certainly the current tendency in central banks is to talk about the rate of interest without any reference to the quantity of money. Well, I put it to you that that is dangerous as well. Let me just, before I finish on this, say that I've been a little bit sloppy in talking about this subject, because in Keynes's theory, he made sure by making the right assumptions that his theory was correct. But he assumed that there couldn't be any inflation. So, sure enough, if there's more money in the economy, then there'll be a lower rate of interest. The trouble with that theory is that in any real-world situation, we're talking about the change in the rate of money growth in any real-world situation. And the notion that inflation is nil, price level is constant, again, is for the birds. So Keynes's theory is very artificial. At least Friedman asked the right question. He said, what is the effect of a change in the rate of money growth? And that harked back to Fisher, and then he got these consequences from the rate of money growth to inflation. At any rate, suppose that we follow the current fashion of looking only at interest rates and seeing bond yields as the short-term rate plus expectations about short rates. Then, well, does this really work? And one of the examples I want to emphasize is the Eurozone. The Eurozone has been around now since 1999 in a meaningful sense. So we've got 20 years or so of experience. All those nations have the same central bank interest rate. They have one central bank. Do the members of the Eurozone have identical monetary and macroeconomic experiences? Obviously not. In fact, in the period 2008 to 2014, there were calamitous recessions in places like Ireland and Greece when Germany was relatively stable. Before 2008, there were big booms in places like Ireland and Greece and Spain and Portugal and so on, when Germany was just slowly sort of moving along in a very stable sort of way. How are these disparities between the different members of the Eurozone that all have the same interest rate, how are they to be explained? They are to be explained by the condition of the banking system and the rate of growth of the quantity of money. Very simple. The evidence is extremely clear. There's a paper that I wrote with Juan Castaneda, director of our institute, which paper is still available if you want it, which showed that in the run-up to 2008, the growth rate of money in the Eurozone periphery was 10% a year, and then the quantity of money contracted in the following 6 years, whereas in Germany, the rate of growth of money was 5.5% before 2008, and then 3.8% in the 6 years afterwards. The contrast between Germany and the periphery is explained by what's happening to the quantity of money. The rate of interest was thoroughly useless. The wider question here is whether economics really has a useful theory of the rate of interest at all. And I would say, if we're thinking about what is it that determines, I know what determines the central bank rate. That's fair enough. The central bank can control that. But we don't have a good theory of what determines the rate of interest in the sense of bond yields at all. We just don't have one. And this question, which was important in policy-making terms, of what is the effect of quantitative easing, a sudden jump in the rate of money growth, a sudden jump, if you wish, in the level of the quantity of money in 2009-2010. This was a very important question. Many economists then translated that into a question about bond yields, and in my view, this is a mistake. It all depends. If there had been a rate of monetary acceleration fast enough to cause inflation to rise to 10-15%, nominal interest rates would have increased because of the rise in quantity of money implied by quantitative easing. In fact, it was a period of very low interest rates. And so Keynes won the argument rather than Irving Fisher. But it could have been the other way around. It all depends. And anyhow, does this subject matter very much? The importance of bonds in most investors' portfolios is quite small. It varies a bit. Sure enough, insurance companies, some pension funds do hold lots of bonds, usually because of regulation. If we think about the household sectors as a whole, for most economies, holdings of real estate, houses, commercial property, offices, factories and so on, and then holdings of corporate equity are far, far more important than bonds. I can illustrate this very simply by looking at the American data going back to the late 1940s. This picture shows you the red bits, to try and make them as important as possible. They're in red. These are the size of changes in the value of bond holdings. The other bits of these bars are changes in the value of other components of wealth. You can see the red bits are tiny. And let's then just bring this together. We compare the change in the value of bonds to the change in the value of the sum of real estate and equities. Again, going back to the late 1940s, you can see that real estate and corporate equity totally overwhelm the effect of bonds. And more than that, there are periods when the movements of the stock of bonds the value of that is in the opposite direction to the movements in the value of real estate and corporate equity. So looking purely at the bond yield gives you a totally misleading picture of what is happening to the economy and the effect of changes in money, because money does determine the movements in these asset prices, the effect of the changes in the quantity of money on asset markets. So this is another case where we have a curse of Keynes and a wretched 1948 Samuelson textbook, which is what's taught in most universities. This idea that bond yields are so important all goes back to those two books. What we should instead be concerned about is the effect of changes in the quantity of money on the value of equities and real estate. That's what really matters in this subject. And the tendency nowadays in most central banks to think of policy simply in terms of interest rates. And by the way, can I just say, many of these economists are awfully casual about whether they mean interest rates in the sense of the central bank discount rate, or the interbank rate, or the bond yield, or the loan rate. All of these people should pay far more attention to what is happening to the prices of equities and real estate. That's really what motivates changes in behavior. And if we want to think about that, I am absolutely certain that what happens in the banking system and the effects of the banking system on the quantity of money is far more important than what's happening to the rate of interest. Thank you.